Good afternoon. We welcome you to our program and discussion concerning the ongoing global COVID-19 pandemic and its potential risks to the stability of the U.S. banking and financial system. I am Jason Cabral, a partner in Nutter's Banking and Financial Services Group, and I'm pleased to be joined by our presenters, Tom Curry and David Cotney. Tom is a partner at Nutter and a co-leader of Nutter's Banking and Financial Services Group. Formerly, Tom served as Comptroller of the Currency under President Obama and was a member of the Board of Directors of the FDIC, appointed by President Bush. Prior to his service in the federal government, Tom served as Commissioner of Banks for the Commonwealth of Massachusetts. We are also joined by David Cotney. David is a Senior Advisor at FS Vector, a Washington, D.C.-based advisory firm working with and advising fintechs on a wide range of strategic, compliance, and public policy matters. David also is a member of the Board of Directors of Cross River Bank, a $2 billion technology-focused financial institution. Previously, David served as Commissioner of Banks for the Commonwealth of Massachusetts from 2010 to 2016. Our discussion today is focused on the implications of the global COVID-19 pandemic on the financial stability of the U.S. banking and financial system, and why our banking industry is better positioned to weather this crisis than it was 12 years ago during the global financial crisis. Tom and David will discuss how financial reform efforts following the global financial crisis set up the banking industry to handle this global pandemic, what the Federal Reserve and other regulatory agencies are doing today to bolster financial stability during this pandemic, and provide a brief update on pandemic and related guidance from the regulatory agencies. With that, I will turn it over to Tom and David.
Thanks, Jay. The recent drops in the global financial markets and the growing risk of a global recession certainly are reviving memories of the global financial crisis, which David and I lived through as state and federal regulators. However, I think there are some important differences. The cause of this economic crisis is a biological pandemic, which in turn is roiling markets and causing financial instability. COVID-19 carries significant and not yet fully quantifiable economic consequences. It's unlike the global financial crisis, as it did not start in the financial sector and emanate outward, and it should not revive the big bank, too big to fail moral hazard debate. However, the federal government's emerging fiscal response to support the broader economy and certain hard-hit sectors is already sparking similar concerns over fiscal policy and the wisdom of rescuing specific industries. The bank regulatory agencies used their supervisory authorities during the global financial crisis and afterwards by implementing the Dodd-Frank Act's mandates to significantly increase the industry's capital and liquidity requirements. Those efforts included improving the quality of regulatory capital, raising minimum capital requirements, and imposing additional capital and liquidity buffers for large banks, and also implementing annual capital stress tests. We're fortunate that U.S. banking organizations have built up substantial levels of capital and liquidity, well in excess of regulatory minimums and buffers. For example, the largest banking organizations hold $1.3 trillion in common equity and $2.9 trillion in high-quality liquid assets, almost double the levels they held at the start of the last crisis. These capital and liquidity buffers were expressly designed to provide banking organizations with the means to support the economy in adverse situations like today's coronavirus pandemic, so banks can continue to serve households and businesses through the crisis and to avoid an economically crippling credit contraction. Generally speaking, banks are better positioned today to handle a crisis like the coronavirus pandemic, largely because of the Dodd-Frank Act reforms and the Federal Reserve's public resolve to take whatever steps are necessary to support liquidity in the financial system and the real economy.
That is true, Tom. Thank you. This is David Cotney. Because of the industry's strength entering the coronavirus pandemic, banks should be in a better position to lend through a downturn instead of conserving capital and liquidity and thereby exacerbating the situation. And when you look at policymakers, they are already acting decisively and cooperating at the global level to preserve monetary and financial stability. Moreover, the stigma or risk associated with banks accessing Federal Reserve-sponsored lending facilities or the Federal Reserve's discount window has been de-emphasized. The strength of banking organizations will allow them to access existing and expanded Federal Reserve-sponsored lending facilities or the discount window without fear of sparking a decline in market value or a run on the bank. During the global financial crisis, accessing the discount window was viewed negatively by counterparties as a sign of weakness or even a risk of failure. Later in 2016, Federal Reserve Board Vice Chairman Fisher said that he suspected the stigma was even higher in the post-crisis period, given the public's incorrect association of the discount window with quote-unquote bailouts. I will note that Dodd-Frank requires the Federal Reserve to publish information on individual discount window borrowers and transactions after approximately 2 years. I'll hand it back to you, Tom, to walk through some of the tools available to promote financial stability.
Thank you, David. The Fed's primary crisis management tool is Section 13.3 of the Federal Reserve Act. It basically authorizes the Federal Reserve to lend to the markets during times of, quote, unusual or exigent circumstances, end quote. I think it's useful to look back to the height of the global financial crisis to see how the Federal Reserve used its Section 13.3 authority. I don't think people realize how creative the Fed was in addressing the crisis. It established 6 emergency facilities, along with establishing dollar swap facilities with global central banks. The emergency facilities include the Term Securities Lending Facility, the Primary Dealer Credit Facility, a form of which was reestablished on March 17th of this year, the Asset-Backed Commercial Paper Money Market Mutual Fund Liquidity Facility, and the Commercial Paper Funding Facility, a form of which was reestablished also on March 17th. The Money Market Investor Funding Facility, again, a form which was reestablished just on March 18th, and the Term Asset-Backed Securities Loan Facility. Federal Reserve lending under Section 13.3 peaked at more than $700 billion in late 2008.
Tom, this is Jason Cabral. You were comptroller during the financial crisis. What were some of the tools that you as comptroller and the OCC had at its disposal to support the national banks specifically?
The OCC acted in collaboration with the other federal regulators, the Federal Reserve and the FDIC, in a very close and coordinated fashion. But the OCC acted very early to assess the situation on the ground with the national banks and required them to cut dividends, raise capital, and increase reserves well before Dodd-Frank was enacted. It also mandated heightened standards for risk management and corporate governance for national banks over $50 billion in assets to ensure that the banks were better prepared for a future crisis. The Dodd-Frank Act, however, also made 3 significant amendments to Section 13.3, which may affect the Fed's current arsenal. It eliminated single entity lending because it was used to lend directly to AIG, JP Morgan, Bear Stearns, and the London-based broker-dealer subsidiaries of some U.S. banking organizations. As a result, such lending now must be made in connection with a program or facility with broad-based eligibility. As a result, it cannot aid a failing financial company or borrowers that are insolvent, and it cannot have a purpose of assisting a single and specific company avoid bankruptcy or a similar resolution. It also now requires executive branch prior approval, which is done through the Secretary of the Treasury. the Federal Reserve cannot establish a Section 13.3 program or facility unless this happens. And what this does is it effectively gives the executive branch a veto over the Federal Reserve's use of its powers under Section 13.3. Finally, the amendments impose reporting obligations to Congress on its use of those powers. The rationale for significantly curtailing Section 13.3 lending authority was the creation of the resolution and orderly liquidation authority provisions of Dodd-Frank, and, importantly, the need for greater accountability to Congress and the public, given the Fed's extraordinary powers under Section 13.3. The Federal Reserve's monetary policy toolkit also is constrained by current economic conditions, primarily the historically low interest rate environment. An historical comparison on interest rates is useful. In 2007, the Federal Reserve's key interest rate stood at 5.25% when worries about the housing meltdown grew. That gave the Federal Reserve plenty of room to slash the rate to near zero by late 2008. Entering this crisis, however, the Fed's benchmark rate was at a range of just 1% to 1.25%, giving officials little room to cut, and it has since been slashed to near zero on March 15th. Separately, 10-year Treasury rates are already below 1%, raising questions about the effectiveness of a renewed bond buying program. The FDIC's ability to provide open bank assistance through the systemic risk exception to the least cost test also was curtailed by Title 11 of Dodd-Frank. The FDIC in the financial crisis era launched innovative programs guaranteeing bank and bank holding company commercial paper, and they are no longer available without congressional authorization. High corporate debt levels and an historically high level of leverage lending are also an area of growing concern. Perhaps the most significant vulnerability to the global financial system and the economy is the estimated $1.1 trillion that banks and other financial institutions have loaned to companies that are already highly indebted. As noted earlier, Dodd-Frank's Title II Orderly Liquidation Authority is now largely in place to handle any needed resolution of a significantly important financial institution or SIFI. The Orderly Liquidation Authority, however, is an unused and untested tool, and its use may spark a political and popular backlash. The coronavirus pandemic is putting the administration and Congress to the test to develop a comprehensive, effective, and timely response to this public health and economic crisis. Hopefully, they will not be stymied by partisanship and political gridlock. I'll now turn it over to David.
Thank you, Tom. And on your last point, yeah, we've certainly been able to come together in past crises on a bipartisan basis, and I certainly hope that our representatives in Washington will be able to come together again this time. But turning to some current regulatory actions, particularly the Federal Reserve, you heard from Tom during the last crisis, the Federal Reserve had to use a lot of creativity to prevent the industry and the US economy from going over the cliff. Today, we can see that they are willing to use their authority to ensure stability in the financial system. So the Fed has established the commercial paper funding facility, very similar to the global financial crisis era facility, and is designed to make sure that any US issuer of commercial paper, including corporate issuers, is able to roll over commercial paper and to encourage investors to lend once again in the commercial paper market. The Fed also established the primary dealer credit facility. This is, again, very similar to the global financial crisis era facility and designed to provide liquidity to primary dealers. On March 18th, The Federal Reserve established the money market mutual fund liquidity facility, similar once again to the crisis era program to support the flow of credit. The Federal Reserve is actively encouraging institutions to access the discount window. The Fed had announced changes to the discount window. Each of the federal banking agencies put out a release encouraging banks to use the discount window. And then we saw an announcement that the largest banks had all accessed the discount window in a show of support. The Federal Reserve announced on March 19th that they were pleased with the increase in discount window borrowing. Many analysts agree that we have entered another era of quantitative easing, or QE4, that may have begun last fall with the repo operations announced by the Federal Reserve. That is now up to $500 billion in 3-month operations and another $500 billion in 1-month operations. The Fed also reinstituted purchases of securities last fall. That is now up to $500 billion in Treasury securities and another $200 billion in mortgage-backed securities. The Federal Reserve is also closely coordinating with other central banks to make US dollar borrowing easier. Finally, the Fed lowered interest rates to near 0%. As Tom mentioned earlier, their starting point was much lower than the last crisis. So I would caution that the Fed's responses in the last crisis were intended to both get the flow of credit moving again within the financial services industry and to jumpstart the economy. The Federal Reserve is continuing to support financial stability with its actions today. However, the Fed's ability to soften the economic blow with monetary policy is more limited because there is little ability for consumers and businesses to be able to respond to the Fed's actions in a way that will stimulate the economy. So while the Federal Reserve can continue to support financial system stability, its stimulus tools may be less effective. So we are also seeing action by both state and federal regulatory agencies. They are acting both collectively and individually to recommend that financial institutions work with their affected customers, borrowers, and communities to make appropriate accommodations consistent, of course, with safe and sound banking practices and applicable laws. For consumers, regulators are encouraging financial institutions to consider waiving certain fees, for example, overdraft fees, late payment fees on credit cards and other loans, and early withdrawal penalties on CDs. For all borrowers, they're encouraging regulated institutions to consider offering payment accommodations, such as allowing borrowers to defer or skip some payments, or extending the payment due date, as well as restructuring a borrower's debt obligation. Finally, they are providing assurances to financial institutions that these kinds of efforts, taken in a prudent manner with appropriate management and oversight, will not be criticized by examiners.
David, this is Jason Cabral. You were the first commissioner of banks immediately following the peak of the financial crisis. In those first few years, what was the division of banks, and you particularly as commissioner, focused on in order to really strengthen the banks coming out of 2008 and 2009?
So, Jay, I would say that certainly while the peak of the crisis had passed when I became commissioner in 2010, the economy had barely started to recover, and regulators, federal and state regulators, were still dealing with the fallout. Significant issues that we had to deal with in Massachusetts and across the country included the foreclosure crisis, which continued, and related mortgage servicing issues. The Massachusetts legislature passed 3 foreclosure bills, 2008, 2010, and 2012, all of which required the Division of Banks to implement through regulation. And then in the middle of this, the CFPB issued its mortgage servicing regulations under RESPA. I also helped to lead an effort with my state regulatory colleagues and attorneys general in 49 states that resulted in a settlement of about $25 billion with the 5 largest mortgage servicers to clean up their mortgage servicing and foreclosure practices. All of these required substantial changes to how banks and mortgage servicers service their mortgages, how they handled delinquencies, including forbearance, and how they proceeded through the foreclosure process. This really was a huge effort to balance the concerns of industry and consumer groups, but ultimately we came out with regulations that improved transparency and provided greater certainty of the processes. Collectively, I think raised the expectations for how to handle servicing and foreclosures during a downturn. I think that can really serve as an example for the issues the banking industry is facing today. Frankly, when you look back, the financial crisis was a scar on the reputation for the entire banking industry, even though when you look, most community banks had nothing to do, of course, with the bad practices that led to the crisis. But there's an opportunity here today for banks, and particularly big banks, given their strong capital and balance sheets, to really reclaim the mantle of trust they once had with the public at large by working with consumers and especially small businesses that we all hope will recover once the worst of this pandemic has passed.
I'd like to add one takeaway. I think what's important about the post-global financial crisis era is that it gave the banking industry an opportunity to really clean up their balance sheets, improve capital, and also in terms of the foreclosure and mortgage servicing issues that David raised, really put a spotlight on operational risks within banks and gave them and their regulators the opportunity to address those issues. And I think at the end of the day, we're very fortunate that we've had 10 years to build up the financial sector so that it can be better prepared to deal with the coronavirus pandemic that we're experiencing today.
I agree with that completely. Gentlemen, thank you for your time and your insights. We all appreciate it very much. I think that concludes our program. Thank you and be safe.
Thank you very much.
Thank you.